Wait, what? Imagine launching a major new crypto index and leaving out the biggest cryptocurrency in the world, Bitcoin. That is exactly what S&P Dow Jones Indices and Pantera Capital have done. But this is not a story about S&P rejecting Bitcoin. It is a story about asking a very different question. On July 20th, 2026, the S&P Pantera Digital Asset Index went live under the ticker SPPDA. S&P announced it publicly one day later, on July 21st, so the two dates refer to different milestones: launch date, then announcement date. First, a critical distinction. This is an index, a benchmark that tracks a defined group of assets.
Here is the basic idea. A user consumes a blockchain service, perhaps executing a transaction, trading on a decentralized venue, borrowing, lending, or using a smart contract application. The user pays a fee. On-chain data makes some of that activity measurable. Artemis Analytics classifies protocol-level revenue, while Luca supplies pricing, reference, custody, market cap, and liquidity data. But be careful with the final step. Network fees are not automatically token holder profit. S&P's own methodology says protocol revenue is an indicator of economic activity and does not imply investor returns or cash flows. Whether activity creates value for a token depends on the protocol's actual design, mechanisms such as burns, buybacks, staking economics, or other forms of value capture. The index screens for economic activity. It does not promise that every dollar of revenue reaches investors. The eligibility rules are more demanding than a simple revenue ranking. An asset needs Artemis data coverage and positive aggregate revenue across the two most recently completed fiscal quarters. New entrants need market capitalization and adjusted market capitalization above $500 million, an adjustment factor above 30%, and a liquidity ratio above 0.5. Meme coins and abandoned coins are excluded. Eligible assets are ranked by two-quarter revenue until the selected group represents up to 99% of the eligible universe's aggregate revenue. Then they are weighted by adjusted market capitalization. At rebalance, the largest asset is capped at 35% and every other asset at 20%. The index rebalances quarterly.
The official launch snapshot says the index began with 18 constituents. The 5 largest were Ether, BNB, Solana, Tronix, better known as TRX, and Hyperliquid. S&P's public brochure names those 5, but does not publish the remaining 13 names or precise launch weights, so we will not invent them. Bitcoin is absent because it does not satisfy this index's protocol revenue test. S&P Dow Jones Indices chief executive Kathy Clay explained in a launch day CNBC interview that Bitcoin is not one of the revenue-generating protocols this benchmark was designed to include. That sounds dramatic, but it does not mean Bitcoin has no value. It does not mean S&P considers Bitcoin obsolete, and it certainly does not prove that altcoins are better than Bitcoin. Bitcoin may have failed the revenue test because Bitcoin was never designed to take that test. Productive protocols can resemble digital economic infrastructure. Users consume services, pay fees, and activity may connect to token economics. Bitcoin's core case is different. A maximum supply of 21 million, decentralized monetary settlement, proof-of-work security, censorship resistance, and fixed monetary policy. Bitcoin users pay transaction fees, and miners earn subsidies and fees for securing the network. But Bitcoin is not normally valued like a business generating protocol revenue for token holders. It is closer to a scarce monetary network. Different purpose, different framework. Ethereum supports smart contracts and applications. Solana supports high-throughput applications and trading. Hyperliquid is built around on-chain trading. Those activities can produce measurable protocol economics. Inclusion is not an endorsement. It means an asset met a specific screen at a specific rebalance. Completed fiscal quarters. New entrants need market capitalization and adjusted market capitalization above 5.
S&P's historical comparison covers June 18th, 2021 through June 30th, 2026. The Pantera index showed an annualized price return of 8.18%. The broad S&P Digital Asset Index showed 0.08%. The ex-Bitcoin version showed negative 13.76%. But everything before July 20th, 2026 is hypothetical back-tested data. It is not live fund performance or money investors actually earned. S&P warns that modeled history has inherent limitations and does not guarantee future results.
Why might institutions care? The first wave of adoption asked, how do we get Bitcoin exposure? A newer question is emerging. How do we analyze the rest of the digital asset economy? Revenue gives research teams another lens. Alongside price, market cap, and narrative, they can study usage, fees, applications, liquidity, and recurring economic activity. It is not the only valid framework. It is one more framework. Could an ETF come next? The index is designed to support index-linked products, and Pantera describes it as a foundation for them. But a foundation is not a launched product. As of this production date, S&P's page shows no linked ETF or fund. Any future product would require a separate manager, structure, launch, and regulatory process. So here is the BTC window view. The takeaway is not Bitcoin is obsolete.